In this module, we are now going to get slightly technical and talk about the structure of securities markets in India. We would advise you to be highly attentive in this module in order to benefit maximum from it. Let's first talk about the types of securities markets in India. Securities markets can be broadly classified in two categories: primary markets and secondary markets. Primary markets are that part of securities markets that include the fresh issue of securities like equity from the issuing company directly to individual investors. Primary market instruments include initial public offering or IPO, follow-on public offering or FPO, rights issues, and bonus issues. The second type of securities markets are the secondary markets, which involve the buying and selling of stocks and other securities among individual investors. The primary focus of this market is on the prices of securities like stocks and equity. The prices of securities in this market is determined by various factors like macroeconomic and industry-wide announcements and trends, news events, and fundamentals of a company, among others. After understanding the various kinds of markets, let's now shift our focus to understanding the various kind of instruments in primary markets that we were talking about earlier. We shall begin this discussion by talking about an initial public offering or an IPO. An initial public offering or an IPO is the process by which a company gets listed on the stock exchange for the very first time. To understand this more in detail, let us take the example of ABC Limited, which wants to raise around 50 lakhs. To raise 50 lakhs, it issues 5 lakh shares of rupees 10 each on the stock exchange. These shares are now purchased by multiple investors through the stock exchange. This is a classic example of an IPO, where the company has successfully raised money through the stock exchange for the very first time. There are two key differences here that we must note between primary and secondary markets. The first difference, which is the obvious one, is that in primary markets, the issuing company directly sells stock to multiple individual investors. The second difference is that in primary markets, the shares are sold on a fixed price. Even IPOs that happen on the stock exchange in real time are ones that happen on a fixed price band. This is in stark difference to secondary markets where prices are highly dynamic based on demand-supply mechanisms. After having understood initial public offerings or an IPO, the second primary market instrument that we are now going to discuss is follow-on public offering or FPO. A follow-on public offering or an FPO happens when a company raises additional funds from the market after having already undergone an IPO. To understand this more in detail, let us continue with our example of ABC Limited. Imagine that few years after its initial public offering, ABC Limited is now looking to purchase new machinery and therefore needs around 80 lakhs for the same. It is now looking to raise this 80 lakhs via the stock exchange. To raise 80 lakhs, ABC Limited issues around 80,000 shares at 100 rupees each, which is then purchased by multiple individual investors through the stock exchange. This leads to the company successfully meeting its fundraising targets through the method of a follow-on public offer. One very important thing that we must recognize here is that when ABC Limited did an initial public offering, it offered its shares at rupees 10, while when it did a follow-on public offering, it offered its shares at rupees 100. Generally, an IPO and an FPO are done few years apart, and if the company performs well in these years, the market rewards it by valuing it higher. After discussing IPOs and FPOs, let's now talk about the third primary market instrument, rights issues. Rights issue is a method to raise funds where a company issues fresh shares to existing shareholders based on the proportion of shares held by them. Let's continue with our example of ABC Limited to understand this better. Recall that after an IPO and an FPO, ABC Limited had around 5,80,000 outstanding shares in the market. Now think of a case where the company is looking to raise around 1 lakh via a rights issue. Let's take the share price of ABC Limited to be around rupees 60. To raise this 1 lakh via a rights issue, the company will offer around 2,000 shares to its existing shareholders at rupees 50 per share. It is up to the discretion of an existing shareholder whether he wants to subscribe or not subscribe to this rights issue. If he has faith in the company, an existing shareholder would opt into the rights issue and as a result would get some shares. Generally, multiple existing shareholders subscribe to rights issues if they have that kind of faith in the company. In this case, shares are allotted by the company on the basis of the amount of existing shares that they are holding. Therefore, if investor X has 500 shares of ABC Limited and investor Y has 400 shares of ABC Limited and both subscribe to the rights issue, investor X will be allocated more shares. After discussing IPOs, FPOs and rights, let's now look at bonus issues. A bonus issue occurs when shares are issued to existing investors and shareholders free of cost. Let's take the example of our favorite company ABC Limited to understand this more in detail. Let's imagine that ABC Limited issued a bonus which was 1:10 in ratio. Therefore, if you held 500 shares of ABC Limited, you would get 50 shares of the company as a bonus. In all, at the end, you would hold 550 shares of the company after the bonus. The primary difference between rights and bonus is that in the case of bonus, all shareholders get the shares, which are the additional shares, and they get it free of cost. After completing primary markets, let's now shift our focus to secondary markets. Recall that secondary markets are those markets where securities like stocks are traded among individual investors on prices that are determined by demand and supply mechanisms. As a virtual investor on Finlatics, you're closely resembling operations of a secondary market. Let's now look at various factors that determine price movements in secondary markets. The first factor that we will look at is market news. Often the market reacts to both negative as well as positive news regarding companies. The most interesting part here is that your call individually on the basis of news matters a lot. This is because often when there is a negative news coming out of a company, it makes way for a good position to buy that company. As whenever there is negative news about a company, the broad price of that stock of that company goes down. So you can purchase it at a cheaper rate if you feel that the company is a good company. Let us take the example of Infosys Limited to understand this better. In October 2019, a whistleblower alleged corporate misgovernance issues on part of Infosys Limited, the IT major. This led to the stock price of that company fall down steeply in one day. Soon after this, the company came out and clarified about these allegations, and therefore around mid-November 2018 the price started slowly rising back up. This is a case of how market news, especially bad market news, impacts the stock price of the company and also makes way for a good time to purchase that company. The next factor that we want to talk about are macroeconomic and industry-wide announcements. These are policy announcements that impact an industry as a whole and therefore impact companies in it. An example of this is that recently India opened up 100% FDI in its insurance sector. This led to share prices of insurance companies like HDFC Life as well as SBI Life go up tremendously. Here, as you can see, a policy announcement impacted the share price of multiple companies in that industry. Tracking policy announcements is one of your key activities as part of the FMEP program. This is another reason why you should consistently read news as part of the FMEP program in order to excel in it. The last and perhaps most important part that helps in determining the share price of a company are its fundamentals. Fundamentals of a company will be covered in some of the modules going ahead, where we will be conducting fundamental analysis on a company by looking at various fundamentals and through certain methodologies. Fundamental analysis and looking at fundamentals of a company before stock picking is followed by many legendary investors, including Warren Buffett.